We welcome you here at the Debate Circle, and in today's episode, we're going to be discussing the Finance Bill 2023. And I know there's been a lot of questions around it, so sit tight. We're about to discuss some very interesting elements. I am joined in studio by an amazing friend of TBC. It will be injustice if I do the introduction for him, so I will let him introduce yourself. John Kiragu.
Hi everyone, morning, afternoon, evening, depending on the time you're watching this. Yeah, my name is John Kiragu. Happy to be back. I do consider myself a tax enthusiast.
Do consider myself.
I'm probably not an expert, but I'm happy to share my views today.
Thank you so much.
Yeah.
We definitely had him here before when we were doing the finance bill. Was it 2020?
2020, yeah.
Yeah.
Back then I didn't have a beard. I do have one now.
Uza Sarah, it's allowed. That was almost 3 years ago.
Yeah.
So I think we'll just jump straight into it.
Yeah.
When we're talking about the finance bill, because ideally one of the things we're really talking about today is we're aiming to educate. I think almost all the content I have watched about the finance bill has been very jargon-centric, very expert-heavy, and also very informative also. But I feel like it's informative when you understand what you're listening to.
Yeah.
So perhaps just kick us off. When you talk about the finance bill, what is the finance bill and what is its relevance when we're talking to the tax system in Kenya?
Okay, so the finance bill is just a piece of legislation like any other. The only difference, I guess, between the finance bill and the other kinds of legislation is usually, I would say, the impact that the finance bill has to the laws, I guess, to the financial laws of this country. So you will notice that every year we have a budget that is read, and then from the budget we get to see a finance bill. And the finance bill itself introduces a raft of changes to the tax laws that we have. So say that's really what it is, a piece of legislation that introduces a raft of changes to our tax laws.
Yes, I love that you introduced it because the next part definitely is we've been conducting some form of public participation because with every other legislation, there is procedure for that to take place. And I remember we were having this conversation and I was asking, have we achieved enough public participation? Do we even really do public participation? Or we like the idea that we are having public participation? Because when you're talking about expanding the tax base or some of these changes, it's very easy if you're already tax compliant to be aware of what the finance bill is referring to. But if you're not in the tax base or in the informal sector, this is like another one of those news articles where you don't get what it's going. So ni sawa. Situko sawa, MPs will do what is relevant. So do you think we've achieved enough public participation?
Wow. I think that's a very difficult question. I mean, and I'm not just saying this because I'm a lawyer, but like enough public participation is really hard to quantify, but maybe just a few steps back. I mean, the first thing we need to all recognize is, I mean, public participation is a constitutional requirement, yeah? So for every piece of legislation that is coming out to the public, and it's not only piece of legislations, but every sort of law, regulation, and even guidelines before they come out and take effect in the public, the public must have a chance to give their comments and their views on the specific law itself. So what is, I guess, fundamentally different what's fundamentally different when it comes to the finance bill itself is that because of the impact that the finance bill has, one would think that a lot more public participation is required. You know, as we said, like when we are beginning, like the finance bill itself introduces a raft of changes to the tax laws that we have in this country. So, and because of that kind of impact that it's having, it's really, really important that the citizens of this country get to participate and give their comments and give their views on the bill itself. So I guess now to your more difficult question, have we had enough public participation? And let's say there are probably two answers. One is a simplistic one, no, because public participations are still open until the 20th. So I guess up until...
It's a continuing process. Yes.
It's a continuing
process.
2
days from now.
It's 2 days from now. Actually, Saturday. Saturday is the last day. Saturday at 5 p.m. is the last day when public participation is being received by Treasury. But then I guess a more difficult question is, how do we think about public participation generally? And there's a lot
is
of...
key. I was about to echo on the same. When we say public participation, are we talking about tweets, Facebook comments, your WhatsApp status? Because how exactly do you go about public participation?
Yeah. So I guess that's what I'm saying. Even that himself as a legal question is somewhat difficult. But we've had a lot of jurisprudence of these issues. And one of the things we are saying that is very clear from the courts is that public participation should not be like a formality. And by this, they're trying to say that each and every time a piece of legislation is received by the public for comment, it needs to be, we are not just doing this to tick boxes and say, oh, we did public participation, but it can't be a formality. And when you're just thinking about, so I guess what would we call the minimum standards for public participation? There's also a lot of litigation on the same. But I would say, at least for most recent jurisprudence, and at least from where I'm sitting, the following things need to happen for one to say there is enough public participation. I guess the first thing is, the thing that we are trying to put in our comments for must be accessible to us. In the context of the finance bill, the finance bill is out. It's on eCitizen, not eCitizen, it's on Kenya Law Resources. It's out here. It was even posted on Twitter. So as Jane, you have access to it. Yes. The second thing is that the citizens must know what they are really doing in relation to the public participation. So they not only need to have information to the public, to the bill itself, but they need to know that they are participating in its comments. Yeah.
This is very tactical answering of this question, but I will assume that what we're doing here is some form of public participation, because one is access to this bill, and two, understanding what the bill is about and what they'll be doing when they're giving their comments. So we're just going to go straight into it. We'll tackle some of the amendments. I had sampled a few areas that I thought cut across a general mass.
Wait, sorry, before we go on, this doesn't count as public participation per se, for the reason that...
Does it inform public participation?
You could say it informs public participation, but like for public participation to be valid in a sense, the citizen must put in the participation in the required form. And what we mean by this is, every time a bill is being put out for participation, the person who is putting out the bill for participation will say, put in your comments in form X, Y, Z, which makes sense, because if we say, okay, John's tweet on his Twitter handle was not considered when Parliament was looking at when Parliament was considering the comments from other people. Because then the question then is, what counts and what doesn't count? So this probably doesn't count as public participation, because public participation then needs to be, you need to participate in the way that you have been asked to participate. So, and in the context of the finance bill, you're supposed to put in written proposals. Okay. Written comments.
That is where I was hoping we'd nail this, but either way, it's not the one of contention here, but written proposals.
Yes.
I just don't know how many of that or how much of that we actually get in terms of the public giving out their proposals and things of that nature. I do not have the figures, so let me not speculate. As John said, we still are waiting for the 20th, so we don't want to say that, we've not had enough public participation. I hope now I'm allowed to move forward.
Yes.
I like how thorough you are with your responses. So we do have some notable changes to the excise tax rates proposed under this bill. I do have a table here with me, and I will just sample two. So we're talking about the excise tax rates. So for money transfers by banks, money transfer agencies, and other financial service providers, we were at a current rate of 20, we're seeing a reduction to 15%. So fees charged by digital lenders, which is different from banks, was at 7.5% and has increased to 20%. So what we were discussing here is, what will be the implications for digital lenders specifically, as the proposed rate is from a 7.5% to a 20%. And we're talking about digital lenders, we're talking about the likes of Tala and the likes. Are we seeing less access to loans given the increase from 7.5% to 20%? not a small percentage change. It's a very significant percentage change. Will this affect how people now will be able to pay back these loans or even have access to these loans?
Yeah, I mean it's an interesting question you raise. Maybe if we just backtrack 2 steps behind. I mean, excise duty initially was supposed to. It's commonly referred to as a sin tax. Yeah. So the idea of its initial idea was it was supposed to encourage, or more specifically, discourage certain kinds of activities. And when you look at the raft of changes that we're seeing in terms of excess duty, there's been significant increases in some of the things, and other things there's a reduction. Specifically to what you're talking about, the 7.5% to 20. Obviously, it's going to have a ripple effect to the cost. The cost of the loans. It could actually ultimately affect the repayment, because then if the loan is much more expensive, it then means that I, as John, who has taken a loan from there, will take much more time to repay. It will also mean that my accessibility to that loan will also reduce. Yeah.
You've said something that's very interesting. When you reference to a sin tax, either encourage or discourage, what is the love-hate relationship here between banks and digital lenders? Because we're seeing a very large increment when we're talking to digital lenders, from 7.5 to 20, and then we're seeing a reduction for money transfer by banks and ideally other providers from 20% to 15%.
Yeah.
Are we having a sort of preference for banks and Nini or Tala, you need to style up? Like, where is this going? Tala is not necessarily.
So the fund of the show. Maybe they're a fund of the show.
It's used metaphorically in this context.
Yeah.
Why encourage and why discourage others? Because my assumption is it is easier for me to have access to some of these digital lenders' services and loans than it is for me to have access to a bank. And there are given factors that we've talked about here. One, we're also dealing with a large majority of Kenyans that are unbanked, or traditionally, their portfolios don't meet the threshold for collateral when it comes to banks. So why the discouragement for digital lenders? Because my assumption would be we would incentivize.
Well, digital lenders, I guess, in my view, have not been the nicest of people. And I'm just saying this. I'm saying this from
Johnny,
a very...
They've called your family members.
No, they've not called my family members. But I'm just saying, I do see why we would want to discourage digital lenders. But ultimately, on some of these things, just comes down to the predictability of how tax legislation is carried out in this country. And I think over the years, this has been a recurring conversation, at least on what basis are we doing X and on what basis are we doing Y. And I think the tax policy that was out, that we have a tax policy that was released sometime in December or last year and last year, and it was open for comment sometime at the beginning of this year. And those are some of the things that it was supposed to address. It was supposed to give us, I guess, clear guidelines on what we're trying to achieve fiscally, in fiscal terms, over the next couple of years.
I know there have been, especially when it comes to KYC and digital lenders, that was a really big issue for quite some time until now. CBK had to come in and reel it in properly. And that was one of the things that ideally would discourage, because if John, you can take loans with my details without my consent, then there's a lot of issues there. But still, there's a level of convenience that we can't fail to recognize here. But I'm guessing you're paying for the convenience in this.
Maybe that's what Hustler Fund was supposed to address.
True, maybe that's what you were supposed to replace. Maybe just to, on the part of reduction of the proposed rate for money transfer for banks, agencies, and other providers, my question was, does this include for international transfers too? Or it's just locally here?
It's most the way the quoting of the law makes it look like it's supposed to be for local. In any case, international bank-to-bank transfers are for the most part, outside the reach of KRA. So it is supposed to make bank-to-bank transactions substantially cheaper, which ultimately has a ripple effect to me and you, and the very many people who have banks. So I think, in my view, that is a very welcome proposal. Yeah.
Okay, either way, we're seeing some funny changes here.
Yeah.
There's also one last bit here. For money transfers by cellular phone service providers, we've seen an increased rate from 12% to 15%.
Yeah.
So we have banks, we have digital lenders,
Yeah.
and we have money transfer services by cellular phone services. Basically, your M-Pesas and things of that nature. Bear in mind, most of digital lending is transferred by a mobile phone and
Yeah.
things of that nature. And we're seeing an increment in both these sectors. I'm fighting for financial inclusion here, because my assumption is my grandmother somewhere in Kadachua will probably use M-Pesa more for access to loans and things of that nature than they would use a bank. My assumption would be to lower the rates in these sectors.
Yeah.
So,
Then again, you're very, very right. And that's why I was just circling back to this whole discussion before I answer your question on the tax policy and the kind of instability we are seeing in terms of the raft of changes that we see from year to year. And we perhaps don't really know why it's being done the way it's being done. But specifically to this proposal that you're talking about, I do have my table here. I brought it with me. And it's from 12 to 15%. And you are right, it's going to have a big impact on people who are mostly unbanked, people who rely on your M-Pesa and the very many other mobile apps for transferring money. So ultimately, it's probably not the most welcome of proposals.
Yeah, because my assumption is, even on my everyday transactions, I am less likely to pay things from my bank account. I'm more likely to pay for things from my...
many even people don't have bank accounts, but they have M-Pesas and all that.
Or whatever, like, mobile service that I'll be using to facilitate this payment.
Yeah.
So it's quite unnerving. That would be costly to use that than it is to use a bank.
Yeah.
Yet my predominant source of money is on my phone.
Yeah.
Either way, as you've said, what's informing this is maybe what we are yet to know. But you've mentioned we have the Hustler Fund. Maybe that's where we're going with this. It's an assumption here. Allow me to move forward here.
Yeah.
So we have the likes of the Debate Circle and friends. Please come closer. Guys, we're in the digital content creation space.
Yeah.
Now, when we do Finance Bill in 2020, again, is when the first time we were seeing a lot of this talk about, we're going to introduce taxes in this sector. And guys are like, how? How will you know that my TikToks are earning me money and things of that nature? So due to the onset of revenue being generated from the digital economy, the government has proposed that the finance bill, a 15% withholding tax on income earned by resident persons from the digital content monetization. So here we're talking about specifically a withholding tax is what ideally consultants, trainers, and some of these other people would be paying. So for the Wananchis who earn income from this platforms. First of all, what is withholding tax? Before we go into the whole digital content creators and how they'll be going about paying this tax, because I feel like this is one of the things that will stay. So even as we're talking about amendments, I don't think we'll miss taxation for the digital space. Just walk us through what ideally is withholding tax.
So first of all, this is a very welcome proposal, guys. We look forward to
to working with content creators. Please, if you need a lawyer to help you with some of these tax issues for your content, please see Kirago here.
But really, so let's speak a bit about withholding tax. So withholding tax is just as the name says, it's a withholding tax. And the way it works is, I, John, have offered you, Jim, a service. You are the one to pay. Yeah? So then the government tells you, okay, you, Jim, before you pay John, withhold X amount of money. And that money you can meet it to carry. And the purpose of having withholding tax regime is for two major reasons. Number one, it enhances compliance. Number two, because as at the point when you're paying me, I'm not taking the money, I'm not going to go spend on a car.
Yeah.
So you have already remitted the
tax to KRA before anything. So in that sense, it enhances compliance. But also number two, it has the effect of registering that income with the Kenya Revenue Authority. And it works like that because when you're paying me, so say you offered me, who was offering that service?
I think you.
I was the one offering the
service, yeah.
So I offer the service, you're paying me, withhold X amount, say 5%.
Yeah.
You remit it to KRA. But when you remit it to KRA, you tell KRA, look, John offered me a service, I'm paying him X amount. This is how much I have held. So, because you're holding a percentage of a larger figure, then KRA will know John earned X amount.
Yeah.
So at the point when John is filing his returns, KRA already knows, and it's in the system that John earned X amount. So when I'm filing my taxes, I'll need to account for the rest of the tax on top. So most times, sometimes withholding tax works as a final tax, which means at the point when you're withholding to KRA is like, okay, we don't anymore.
And specifically, withholding tax for residents and non-residents.
Yes.
That's a key thing there. So for residents, in what scenario is it the final tax? Because I think that is some of the questions.
On the tax itself. So you have to look at the tax itself. So you'll notice withholding tax specifically spoken about in section 10 and 35 of the Income Tax Act. And there are certain withholding taxes that are final, others are not final. Yeah. So you'll find that most times withholding taxes that are being levied on residents, that is people who are not here, in a very simplistic way, you'll find those ones being final. For the simple reason that if John is paying a person abroad for money he's earned here in Kenya, and he's away, it's a very taxing thing to go tell Kenya,
go look for that guy.
So in that sense, we want a final tax, and you find residents withholding tax on non-residents to be slightly higher than withholding tax on residents. So when it comes to residents, some withholding taxes on residents are final, some are not. Depends on the kind of service you're talking about. So, like in my field, I'm a lawyer. The withholding tax on professional fees, management fees, is not really final when it comes to residents. So we hold a bit of it, and then John has to account for the rest.
Okay.
Yeah.
I think this probably does a better idea of it. And then since it's a new space, I would always advise that you consult with a tax expert, especially if you have multiple streams of income. Please not be of the assumption that your withholding tax is your final tax. Something else that is interesting here also when we're talking about the digital content income, there's something about digital assets. The bill proposes to add a 3% tax on the income earned from the transfer or exchange of digital assets. So the owner of the platform or the person who facilitates the transfer or exchange will be required to deduct a digital asset tax and remit it to the commissioner within 24 hours after deduction. My question is first, what form of assets are this? What form of digital assets are we talking about?
Yeah, I mean, and just to just take a step back. I feel like every time I say take a step back, but these are welcome proposals in my view, for the reason that for a very long time we've been pushing our government and our police advisors to expand the tax base. And we have statistics suggesting that we have a good majority of young people in this country who are making a proper living on making content online and dealing in digital assets. When we're speaking about digital assets, we're speaking about your crypto assets, cryptocurrencies, crypto assets, your NFTs. And people have actually been making money and good money on it.
Which feels 3% is like a very small percentage, but it's a good starting point.
And also, to be fair to that specific recommendation, remember the way the taxation system in Kenya works is all money that has been earned or derived from this country is subject to tax. So I guess an argument could be made that these monies were already subject to tax. And if KRA really wanted to get to these people, they could have, and they would be within the legal mandate of the law to do it. But I think the biggest struggle when it comes to, for example, things like digital assets. So like now, let's say you get to charge 3% of the fair market value. On the increase in the fair market value, which will then bring a lot of complexities on, I guess, the valuation of an NFT.
Yes. Which is already problematic within its own space. How do we actually value these NFTs and how they depreciate and appreciate is also something that's very unpredictable.
It's really unpredictable, and the bill itself doesn't speak about how that is going to happen.
I think it's still open to.
It's still open, but I think it's one of the more welcome proposals.
Sure, yes, that one has been a positive for revenue collection. I think to move us forward, which is like the bone of contention for a lot of people when they're talking about this financial bill, is the increased rate for personal tax. So the bill proposes to increase the highest tax band for personal taxes to 35% for employees earning more than 500,000 monthly and 6 million annually, ideally. Again, we're asking, is it justified? Are we hoping to tax ourselves to economic stability? What justifies that? Because I've had a lot of conversation around how many people actually earn 500,000 a month. I mean, inshallah, it's hopefully one day, but it's a very small percentage, and the 35% feels almost harsh, for lack of a better word. Is it justified?
Is it justified? That's a difficult question, like Daniel was in the past, but really, you raise very interesting questions and very genuine questions. But we did see statistics not so long ago about that stated about 74% of Kenyans earn below
50,000.
And then again, this dark backdrop we're seeing the carry, not really the carry, but the finance group saying that they want to tax people are earning about 500 at 35%. Like any income you make about 500 in tax at 35%. And historically speaking, this is not the first time we're seeing this. There has been in previous instances trials to have the highest band in tax at 35%. So this is not really the first time we're seeing this. I think the first time we saw this, they were trying to tax people who earned above 700,000. So any income you earn above 700,000 shillings, you tax it at 5%. But
I think it's important to note here, we're talking about employees. We're not talking about SMEs and turnover tax. We're talking about employees that you, John, once you start bagging in retainers that give you 700,000, will be liable to this personal income tax rate.
That's right. And my question is,
I'm almost tempted to do the math. Like, how much is actually 35% of this amount? It's a very significant sheet.
So you remember the way our Kenyan tax bands work. Yeah? So the thing is that you're taxing 35% of all income you earn above 500,000. And back to your initial question, I don't think we have very many Kenyans who earn that high.
So someone could argue we should even stop complaining, because if you're not in that tax bracket, please, you need to consider your life choices critically here.
I think somebody could argue, somebody could make a good argument that probably this won't build a lot of revenue.
Yes.
But then again, I'm just saying this without seeing the data that maybe other people might have.
Yes.
But my suspicion is as good as yours.
Because we know about the 74% that earn less than 50,000. Of this 26%, you don't know how many are in that tax bracket. So.
And it's even a smaller percentage of people who are foreign employed.
Yes.
So then again, it probably won't yield a lot of results. But then again, that's the point of public participation. Perhaps that's something that TBC should be doing, right?
It's the assumption that we're making that much money, but we thank the Lord. The National Housing Development Fund, which our administration is very fond of funds. We have the Hustler Fund, we have a lot of funds.
Yes.
So the bill proposes to introduce contributions to the National Housing Development Fund. The employer shall remit in respect of each employee. So your employer's contribution at 3% of the employee's monthly basic salary, and the employee matches it up to contribute 3% of the employee's monthly basic salary. the total contribution is above or capped somewhere to like 5,000 a month. That is both for the employer and for the employee.
Yeah.
Now, again, as I've said, there seems to be a lot of talk about funds in this administration. The first thing for me was if this is constitutional, one, and if it passes to the Financial Act, are there options to opt out of such a fund if one wishes to build on their own terms?
Yeah.
So I was listening to the PS explain how they came up with this mathematics. He was on we're talking about the PS Charles Hinger. He was on Spice FM. I think we'll link that interview here. He does a brilliant explanation of how they came up with the numbers for the National Housing Development Fund. I will try to my level best to break it down.
Yeah.
So he states that the average cost of building a home in Kenya is 11 million. That's cost of land and building and everything involved. And you're saying, given that 74% of people earn less than 50,000, if they were to apply for a mortgage at a considerable 14% market-based interest rate and at 11 million, you would be paying, it was close to something like 153,000. Haven't checked up on the math. And you're saying if you're earning less than 50,000, that's definitely not a home for you, which means we're ideally building a market for like the very small percentage. Now he was going back to, let's work with the 50,000. In comparison to other markets, that is outside of Kenya, the cost of land in ratio to building was around 15 to 20%. In Kenya, it's around 30 to 50%, which means a very big percentage of your building a home is related to buying the land. So they were of the proposition if the government could provide the land, it's reduced the cost of purchasing the land. So he was saying by reducing that cost, they're talking about homes that will be going for 3 million a unit. Given again the mortgage calculation, if you were to take a mortgage for this affordable housing, he was given the same entity, 10 years, 14% market-based interest. You would be paying 47,000 per month as a mortgage for this housing project. But then he was like 47,000 and we're talking about 50,000. So it's not making sense. And then he goes ahead and further looks for a way to reduce this amount that we'll be paying for 47,000. You say one, because he was saying the other challenge that they had is most of the land they had was in Western Kenya, the likes of Migori, Siaya, Busia, and things of that nature. And they were asking developers to come and at least purchase some of this land, and most of them did not want to build investments there. They preferred getting land that was in Nairobi because, of course, the market value is at a better position. So they were saying to solve this problem is first offer the land. On top of offering the land, incentivize in terms of taxes, reduce the VAT that developers would have to do in terms of importation, remove the cost of land, and then the first time homeowners, there was no stamp duties. He was talking of 300,000 mortgage relief if you're a first time homeowner. And then he was saying even after you do these reductions, it was still not affordable. So they went ahead and came up with a rate, 5% rate, which is what the president was saying. A lot of government employees take advantage of this sort of schemes. So he's saying if you lower the rate to 5%, remember we're moving from 14 to 5%, which is a significant decrease. He's saying what would curb the cost to make these homes affordable is having a national fund where we already have the land. We have a sort of chama, a national chama where we've brought the money together and we're giving developers on top of tax incentives to build homes at a way cheaper cost than it would be to build homes on other sort of entities. And you're saying, given the amount of people that are in the formal sector, he was estimating it close to 9 billion a month. And you're saying 9 billion a month is money ready for us to put up these buildings, which means you would move into these homes faster and it would cost you lesser. Now, this was a catch-22 when I was listening to this whole process. Fine, we've come up with a chama, we've formed this whole scheme. The problem is you would still have to pay mortgage to access this home. So you've changaed, yes, but you still have to take a mortgage, but then it's a cheaper mortgage. Now you're saying it was as cheap as the rent people pay in Nairobi. Now, of course, we're using Nairobi as a standard here. We don't know what people in Samburu or people in other areas they could still afford the 15,000 that we're talking about. Anyway, it's a long math. As you can see, the deductions are great here, but I found it interesting because the biggest argument was this isn't informed, where are we coming up with these figures? But he did a good job of explaining where we're coming with the figures. We'll link that interview below. I think he does a better job of explaining the math than I do.
Yeah.
For me, the question was,
in this country. And I guess this is one of the steps that the government is thinking about to make housing more affordable. The problem is the way, so is it constitutional? At the moment, since the finance bill has not yet been passed into law, so I guess it's not really law yet. So its constitutionality is not questioned yet, at least not to me. But I do think when you think about a chama, number one, there is the voluntary aspect of joining a chama.
well, it's called a fund. A chama is what Jane has chosen to call it.
It's the word that you've used, but so I'm going to use it. So in this chama that we are talking about, I mean, number one, the voluntary aspect of it, I guess, must be called into question. But what is more important to me is remember that. So remember who. I think the question we should be asking: who is this going to impact the most? And the biggest challenge I have on this is it's impacting the people who are formally employed. You know, the 74% of
Yes.
the people who are earning below 50K. So if
Yes.
you earn 50,000 and somebody is saying bring 5K, already that's so much.
We're
Over
talking
and
about
above-
50,000 and below. So
Yeah,
it could be a
50,000
spectrum here. You and your
and below.
20 Gs remove your 5 Gs, which is probably a big part of what you're currently already paying for rent.
It is already in that sense, it's already very problematic because then we are seeing a big burden being placed on people who really don't have a lot. So perhaps maybe one way to solve that question is to have an opt-in mechanism. So it's not mandatory; it's opting in. Yeah. But then number two, obviously you can see the cost this will have on your employers because then employers are being forced to match your contributions, which will then mean that as an employer, I'm being forced to pay more, which has an implication on my cash flow.
Yes.
So remember these employers who are paying
On top of statutory
on top of statutory deductions
deductions.
and the very many other afterthings that are coming that are going to make doing business in this country that much more expensive. Yeah? So it's a burden on both the employee and the employer. And I guess one could say, as you rightly pointed out, there.
And is it really a burden that your employer wants to
It is
take up?
It's a tough burden because it has cash flow implications.
Yeah.
And you could say, as you said, that there are opt-outs. There is an opt-out. There's a way you can opt out. And as it's currently drafted, there are two opt-out mechanisms. Number one, retire, or you contribute for 7 years, whichever is earlier.
Yeah.
The problem is, so if I wait until retirement, that's all well and good, and I could reap the benefits from the fund. Yeah. Or in the other alternative for me waiting 7 years, that's I think probably more problematic because after 7 years, if I want to opt out, that money is at the point when I'm getting it, say in cash form, I'm going to have to pay tax on it. Now the problem with that is the other thing. So like let's just compare this with pension. So the way pension works in this country is if I'm contributing a pension, I contribute X amount, my employer matches X amount. So currently the maximum you can do is 20,000. So if my contributions are up to 20,000, that's an allowable deduction. So at the point when then I'm getting this money way later after I'm retired, and now I'm getting the money, I'm taxed at that point. But remember, at this point, I'm not being taxed on it because it's an allowable deduction.
Yes.
compare this with this new mechanism here where we're being told, so you submit your 3%, your employer submits your 3%, so you get taxed on it initially because they're not saying it is an allowable deduction. Perhaps post public participation, it's going to have some changes, but as drafted, it doesn't seem to look like it's an allowable deduction. So as at this point, I'll get taxed on that money. Then 7 years later, when I'm opting out, I'm being taxed again. So number three, there's already a double taxation there happening. Over and above the burden it will have on me as an employee, the burden that it will have on my employer.
Anyway, it is an interesting one because I know of people that are for that fund, especially given how emotional home ownership is. The way we buy land in Kenya is not a logical process. It's a very emotive one, you know? Watajua nimenunua shamba. It's very emotive and there could be good that comes from it. But again, as you've said, it should be open to a lot of amendments.
There's a bit of thinking that needs to be done. A bit of restructuring, maybe we'll have to go into it.
And I would really like the PS. I don't know if we could put it out there. If this information, you did an interview with Spice FM, if this could be more of what we're discussing on TV and the like, because a lot of people don't understand the math behind it. It was really fascinating how he came up with that.
But we do have an opportunity to put in our participation before Saturday.
I don't know by Saturday if we will be having this.
That's how you make the PSPIU. But
yes, we're getting to that. Allow me to move on. So we have exemption on liquefied petroleum gas, LPG, from VAT at 8%. So the proposal enhances affordability of LPG in addition to promoting environmental preservation, because we all agree that LPG is a better environmental alternative. However, this is the part where it's the devil is always in the details. LPG suppliers will not be eligible for input VAT deduction arising from the supplying of this LPG. Now, I do not want us to go very far. You will briefly talk about what we mean by input VAT, so that when we say that the suppliers will not be eligible for that input VAT deduction, ideally the additional cost will be, my assumption is, will be to the final consumer. So it's like, okay, we have exempted LPG, but you will kind of carry the cost. Explain that bit.
So the way value added tax works in these countries, I guess 3 buckets you put goods and services in. So number one, you could be putting those goods and services in a bucket where you're putting a 16% tax on them. Let's call that bucket number one. So let's call it 16. So it's either 16 or 8% as it was for fuel. Then there's bucket number 2, which we are calling the exempt status goods. And for these exempt status goods, what happens is we have goods that are exempted from VAT altogether. Then we have bucket number 3, which are called zero-related goods. And these goods are goods where you charge VAT at 0%. So the way VAT, so in light of those 3 buckets, then the way VAT works is, I, John, am producing goods and services. Somebody has charged me VAT, because I bought some water, bought some electricity, I bought X materials that are subject to VAT, so I've been charged VAT. That's my input VAT. VAT that I have incurred on my inputs, the things I've used to produce my goods and services. Then, if my goods and services fall within bucket number 1, where we get to charge VAT at 16%, when I'm selling them to you, I'll charge you
an output.
So let's just think about, say, a book, an exercise book. We'll have, dropped some trees, then we'll have bought some glue, some bleach there, then we'll have produced the paper. Have we charged 16% on all those things? Then I'll charge the final consumer at 16%. So what the law allows you to do is to offset. So the VAT that I'm charging you, I'll collect it on behalf of the Kenya Revenue Authority. I'll deduct the VAT that I have already been charged. And then the difference, the money that remains, I submit it to carry. So if there's money that remains after I've subtracted what I've been charged, I give that money to carry. If there's no money, so if I'm in a negative position, that is more people charged me VAT than I have actually charged
Charge
other
the
people.
customer.
I tell Kere,
You owe me.
You owe me.
Yeah.
And most times what happens is that it's just put in your account as a credit, and then the next time you owe them, you set, yeah. But so now when you come back now to, so your input VAT, simply put, is the value added tax that is charged on you as you're producing
Goods and services.
Now, in relation to the LPG, you have rightly noted that the LPG is now exempt, yeah, and not zero rated. So the big difference between exempt and zero rated is, for zero rated goods and services, you charge VAT at 0%, which means my input VAT, I will be charged by whoever I'm being charged VAT. My output VAT will be at 0%.
At 0%.
So I won't charge anyone
out.
Output VAT. So when you net off, what happens is more people will have charged me VAT than I have charged you. So I tell KRA, you owe me X amount. So from a person who is a producer of goods and services, I'm in a better off position. Exempt goods are not subject to the VAT regime at all. So I'll incur input VAT. I won't get to charge anyone VAT because it's an exempt goods. Yeah. So, but then what that means, because it's outside, I don't say outside, but that's the effect. It's somewhat that good and service is outside the VAT regime. This input to VAT I get to incur it myself because I have nothing to offset it against. Yeah. So in relation to LPG, one could say that maybe we are not there yet, but
it's
better off because we are coming from 8% as it currently is. We are moving to exempt. Perhaps in the next financial cycle we'll move to zero. I mean, given the president's stance on global warming and the environmental impact. So one could say that maybe this is something that we'll see in the next financial cycle. One could also say that the comments that will be put in will be driving and pushing for it to be zero rated.
Yes.
Wait to see. But ultimately, as drafted, we are better off. That provision is better than what we currently have.
Okay. Yeah. Now that we're talking about VAT, of course, the bone of contention here is petrol, kerosene, aviation, which is currently at a status of 8%, which is proposed to a 16%.
Yeah.
And I know every time we touch taxes and petrol, there's a massive outcry, which is justifiable.
Yeah.
I don't understand the move for it, because as much as we want to move to more environmental friendly, environmental friendly sources of energy, which is a good initiative that the president is following up on some of the agreements that he's put, I don't know if we have buffers.
Yeah.
Do we have alternatives in the case that this is expensive? What is the alternative?
So this I think is the one that's going to pinch Kenyans the most, more than the 35% on.
Because 8 to 16 is double. You know,
it is double, and what this will mean is obviously goods and services will become much more expensive, just because of the ripple effect that petrol has in the way we run our economy.
Yeah.
So I guess one could argue that this is not really the correct time to do it. That would be my view, because
just to add, we're talking about petrol, kerosene, aviation fuel, jet fuel. Yeah. So I think people usually think it's a blanket statement for petrol. It's cutting across very many industries here.
It is cutting a lot of across very many industries, but I think the one that touches very many Kenyans
is petrol. Kirago is trying to say, I'm panding ndege, so relax.
Well, I mean, it could also mean that your flight tickets are going to be
might be a bit costlier,
more expensive. But ultimately, the economy is we are going to feel the shock of this, and this is coming at, in my view, at not a very good time. We're at a point where petrol in and of itself is not very available there. Then over and above the scarcity, compare the depreciating currency that we have, that is Kenya versus the dollar, and we buy our fuel in dollars here. Then over and above that, add
the taxes now. So
add now the another 8%, you know, 50% increase in tax. And this is again also coming at a backdrop of subsidies in fuel that have been decreasing. So I guess one could say this is probably not the right time to remove it. Perhaps it would have been better, and I had somebody argue this just the other day. Perhaps somebody would have been better if this was put maybe years back when the economy was a bit better. Then maybe now we'll have adopted to it. But ultimately, if this passes as is, then we're going to feel
the pinch.
But then again, we have a chance to put in our comments.
Siku ni mbili. I think I'll just touch on two last things in the interest of time.
Yeah.
Hopefully we can do a part 2. This conversation is very wide. There are very many proposals. We can't exhaustively cover them in this 1 hour. Just one last thing is still on VAT. So we have certain capital goods that the Cabinet Secretary determines to promote investment in the manufacturing sector that may be exempted.
Yeah.
That is, if the value of the investment must be at least 2 billion shillings. The at least is very important here. So previously, the current status of VAT for such capital goods was exempt. And now the proposed rate is 16%. And I remember we were talking about this, and first, capital goods, I think it's very important that you explain to us what capital goods are before we go to the implications that this has on the manufacturing sector, given we've been really pushing for more revenue generation, and especially in the manufacturing sector.
Yeah.
Yes.
So capital goods are just what I call capital assets for lack of a better word. So it's those things that you have in your business that you use for purposes of producing goods and services, but mostly goods, yeah. So your typical machinery, your typical tractor, those are your capital assets. Yeah?
Mm-hmm.
And what was happening here is that previously the Cabinet Secretary had the material ability to exempt certain capital goods if they met that threshold of 2 billion.
At least 2 billion. Yeah.
So one could argue, rightly so in my view, that it probably didn't benefit very many Kenyans. Yeah, given that, because then again, 2 billion is
2 billion is that is what I was saying.
high
The details is always in the enemy is always in the details. Because I remember reading about it and then I was like, wait, at least? It's like 2 billion is not your typical manufacturing
it's not really
farm. So
it's
even if you say this was an exempt,
Yeah.
it really didn't cater to anyone. And then again, we have 2 days to make public participation here. Yeah. So is it possible that even as we are increasing the proposed rate to 16%, can we talk about that at least 2 billion? Because I don't know what the current valuation of a manufacturing sector is, but my assumption is 2 billion is quite high.
It is quite high. It might be. I mean, when you think about an asset that you need 2 billion to purchase,
Yeah, you're a large taxpayer in this case. You're not even an SME anymore.
but one could say it's going to discourage a bit of investment. My view is people who are caught in this 2 billion threshold are people who are massive investors. Yeah. That is actually the implication.
Yeah.
So perhaps these are not people who we want to disincentivize.
Yes.
But
Given
again,
we're talking about revenue creation, we're talking about job opportunities and employment, and locally we haven't had that level of capacity. So if we're having foreign investors that are coming in with that level of capacity,
it makes sense to allow them. I mean, and even given the government's initiative to make Kenya and Nairobi a hub for business, so then again, that's changing. I know very many Kenyans will sleep well at night
without being affected by that.
That.
But on a visionary perspective, I do agree with you on that it would be better if we incentivize such a sector instead of increase the taxes. I think just to close us off, there's probably been more conversation about the debt that we're struggling with in this country in regards to the taxes that we're imposing. So does this finance bill solve our debt problem? Because the typical mwananchi understands, you're charging me more taxes, mulipe hizi deni.
Yeah.
Tumalize hizi deni. So the question is, does it actually solve our debt problem, or does it just facilitate budget and treasury to make sure we survive throughout the remaining financial year?
The reason I'm laughing is because, Dawaya Deni ni kulipa. That's really the
True.
only way
I mean,
to solve the debt problem. But in relation to the finance bill itself, I think we have a raft of very good proposals there. And then we also have a raft of very, maybe not so well crafted proposals, but with very good intentions.
Good intentions, yeah. I was about to say the same thing. The intention is definitely there, just hasn't hit home yet.
Yeah. And then we have some things that are way, but I think ultimately in relation to our debt, I think maybe, maybe specifically to the finance bill, I think we need to clap for our government for the effort they put at least to diversify the tax base. And one could argue that that's a step in the right direction. For
It is. I think the few finance bills that have found me of sane mind to actually read, this is the first where what you're saying is really coming out, that diversification.
They are really putting a bit of effort.
Yes.
Ultimately, our debt problem will probably not be solved by a finance bill.
So, Dawaya Deni ni kulipa. But thank you so much for that. I think probably to wrap up this conversation, if you could give your closing remarks. We've heavily talked about public participation here. I think your camera is here. Kirago, please talk to your village mates. What do you have to say about your closing remarks?
My closing remarks, I think, would be this. The reason why we have an opportunity to participate at every cycle of the finance bill is because the voice of the people is very critical. The voice of the people is very critical for purposes of legislating. I mean, this is the only time, as a Kenyan citizen, you get to make your voice heard, in this process. So I would say if you have an opportunity to participate and give your comments and views, please do so. Please do so. You can do this in groups. You can do this as individuals. The deadline is 20th. That is on Saturday before 5 p.m. Yeah, I'd say that is.
Thank you so much, Kirago. We would continue because there's so many amendments and propositions in this finance bill. But in the interest of time, allow us to come to an end to this conversation. If you do have questions regarding to some of the things we've talked about, please feel free to comment down below on this video. Ask your questions. We'll be willing to answer some of them. You could give us some of your propositions. I don't know if we can help. Kirago said this doesn't qualify as public participation. But we are open to informing people more about the tax regime and how things work in this country. And until next time, it's definitely goodbye from us. Don't forget to follow our channels here at The Debate Circle on YouTube, on Twitter, and on Instagram.